Okay, let's dive into this really fascinating moment where Japanese politics and global finance are colliding. We're looking at a perfect, almost real-time example of how a political victory can almost instantly create huge uncertainty in the markets. So our mission today, we're unpacking the aftermath of the LDP leadership election in Japan. We'll follow Sana Takaichi's win. She secured the leadership of the Liberal Democratic Party, the LDP, and then, crucially, we'll analyze how the political instability that popped up right after has already started impacting financial assets, not just in Japan, but globally.
Exactly. And that's the core tension, isn't it? This is what makes this whole situation so interesting to watch. You had Takaichi winning the LDP leadership on October 4th. Now, normally that should have basically guaranteed her the prime minister's job, but almost overnight that political stability just, well, it vanished. It all hinges on a major threat from the LDP's longtime coalition partner, the Komeito Party. So the market priced one thing on Victory Day, and now it's scrambling to price in this completely different political risk factor.
Right, and that's where it gets really interesting for me. Before all that uncertainty kicked in, the markets actually reacted pretty strongly just to the idea of Takaichi leading, didn't they? She kind of represents more stimulus. So what exactly was her policy platform, the key pillars, and how did investors initially react? What did they price in?
Well, yeah, from a finance angle, her platform was definitely market moving
Oh,
because
yeah.
it essentially doubled down on the main drivers of Japan's economy recently. First, she's a strong supporter of expansionary fiscal policy. That signals potentially huge amounts of new government spending. And that spending would likely be funded by issuing more Japanese government bonds, JGBs.
Okay, so more spending, more debt. What was the second pillar?
The second, and just as important, was her commitment to a slower pace of interest rate normalization from the Bank of Japan. So basically, the message to the market was, get ready for more debt-fueled growth, and don't expect the central bank to raise rates anytime soon. For global investors, this sounded a lot like Abenomics 2.0, maybe even, Abenomics on steroids.
And the immediate reaction. How did the financial world respond to those expectations before the political trouble started?
Oh, the reaction was fast, and initially positive. We saw Japanese stocks, equities, rally quite significantly in the run-up when confidence was high. The Topic X index, for example, moved up strongly. But the most revealing sign, I think, was in the bond market. The Japanese government bond yield curve steepened, and quite significantly.
Okay, explain that steepening for us, because that curve shape tells us what the market thinks about future growth and inflation rate.
Precisely. When that curve steepens, it means the spread between the interest rate on short-term bonds, like the 2-year JGB, and long-term bonds, like the 10-year JGB, got much wider. It's a classic bullish signal, really. The market was basically saying, okay, we think Takaichi's big spending plans will lead to faster growth and higher inflation down the road, so we demand a much bigger return for holding 10-year debt.
Ah, right. But because she also promised slow rate hikes, the short end of the curve, the 2-year yield, which is tied more closely to the Bank of Japan's current policy rate, stayed low.
Exactly. So you get this divergence. Low short-term rates, because the central bank isn't moving yet, but higher long-term rates because the market expects future growth and inflation from the spending. That difference creates the steepening.
It really shows how much political expectations directly influence asset prices, even before policies are actually implemented. Okay, so now we have to pivot. Let's talk about the political risk that blew up after her victory. The market priced in smooth sailing based on the LDP win. Why did things suddenly get so uncertain?
This is where we shift gears from finance to, well, pure politics. And it all revolves around the Komeito Party. Komeito is the LDP's crucial, long-standing coalition partner. They've been together for years.
Indispensable, you said. Why indispensable?
Well, generally, without Komeito's votes, the LDP doesn't have a solid majority in the upper house of the Diet, Japan's parliament. And that majority is absolutely critical for passing key legislation, especially the budget, which involves approving new debt issuance.
Okay, so Komeito holds the key to getting things done. And the instability now is because...
The instability is because Komeito is potentially threatening to withdraw from the coalition. That's the bombshell.
Wow. But why? Why now? The LDP has governed with stimulus for ages, often with Komeito support. Isn't Takaichi just continuing that general approach?
But that's the nuance.
Hmm?
Takaichi represents a distinctly more, let's say, hawkish, nationalist, and fiscally maximalist wing of the LDP. Her spending plans are seen as truly enormous, maybe even extreme, and very much debt-funded. And that's a problem for Komeito. Their support base is different. They tend to draw from more moderate, maybe socially conscious voters, often in cities.
Okay, so a different voter base.
Right. And Komeito's voters tend to be more cautious about racking up huge national debt or pushing very aggressive policies that might not seem to directly benefit them. So the fear for Komeito is that Takaichi's specific political brand, combined with these massive spending plans, could really hurt their standing with their own moderate voters. They could lose seats in the next election. For Komeito, it seems protecting their own identity and voter base might be starting to outweigh the benefits of staying in a coalition led by someone they seem to fundamentally distrust, ideologically speaking.
So it's a real paradox then. The very policy platform, big spending, slow rate hikes that initially boosted stocks and steepened the yield curve, is the exact same platform that's now alienating her essential coalition partner, creating this risk of political gridlock almost immediately.
Precisely. It's a sharp paradox.
So what are the actual practical consequences if Komeito does pull out, or even just credibly threatens to?
The legislative fallout could be huge. First, there's an outside chance, if the opposition parties manage to unite behind one candidate, that Takaichi might not even become prime minister. That seems less likely, but it's on the table.
Okay.
Second, and probably more lasting, even if she does take office, losing Komeito means she'd face immense challenges passing legislation. We're talking everything. The annual budget, which is critical for approving that new debt,
Right.
and any specific stimulus bills she wants to enact. It would be incredibly difficult without Komeito's votes in the upper house. So this political fluidity, this uncertainty, completely undermines that smooth policy implementation the market initially priced in. The whole risk calculation changes. It shifts from, will the policy work economically, to, can the government even get the policy passed politically? That's a different ballgame for investors.
That is a fundamental shift. So let's bring it back to the markets. If Takaichi faces these huge legislative hurdles, maybe even paralysis, how does that political friction feed back into the financial impacts we discussed earlier, the yield curve, equities?
Well, it creates a massive potential divergence, doesn't it? Remember, that initial yield curve steepening was built entirely on the expectation of quickly implemented, large-scale fiscal stimulus driving future inflation. If she can't actually pass the necessary laws to make that stimulus happen, or if it gets watered down or delayed significantly, well, then that whole narrative collapses.
So the expectation disappears.
Exactly. If policy paralysis sets in, market expectations for future inflation would likely drop sharply. If investors lose faith in the government's ability to deliver that stimulus, you'd expect the long end of the JGB yield curve, the 10-year yield, to fall back down. The curve would likely flatten, completely reversing that steepening we saw after her victory.
So the curve could flatten or maybe even invert again.
In an extreme scenario, yes. It highlights how political negotiation and gridlock, rather than just pure economic fundamentals, can suddenly become the main driver of bond yields and market volatility.
Which brings us to the critical point for our listeners globally. This political drama in Japan, it's clearly not just a local story, it's a global market event. Why should, say, a fund manager in London or a currency trader in New York care so deeply about the internal politics of the Komeito party?
Because of the sheer scale and the interconnected nature of global bond markets. Japan is the world's third largest economy, a massive global creditor, and its government bond market is enormous. JGBs are held by institutions all over the world. The direction of Japan's fiscal policy, how much debt it issues, affects global capital flows, interest rate differentials, everything.
And the currency aspect, too. The yen.
Absolutely crucial. Japan is famously the source of the carry trade. Global funds often borrow cheaply in Japanese yen, where interest rates are near zero, to invest in assets with higher yields elsewhere. If there's major uncertainty about the future direction of the yen, or importantly, if Takaichi's commitment to slow rate normalization by the Bank of Japan looks politically shaky because of this gridlock, that could trigger a massive, rapid unwinding of those global carry trades. Investors rush to pay back their yen loans. That causes huge volatility, not just for the yen, but across global currency markets. Suddenly, Tokyo's political instability is everyone's problem.
Right. So the conclusion from the sources we're looking at seems pretty clear. The next Japanese government's approach to fiscal policy, and maybe even more importantly, its ability to actually execute that policy, is something the world needs to watch very, very closely.
Couldn't agree more. A breakdown in a political partnership in Tokyo can, almost literally overnight, reshape yield curves and risk appetite globally.
So Japan really is offering us this perfect real-time case study. Shifting political alliances, translating instantly into shifting yield curves and stock evaluations.
It really is. And maybe that leads to a final thought for you, for the listeners, to sort of mull over.
Yeah.
We saw Takaichi's specific policies, that mix of big fiscal spending and slow rate hikes, were the key driver for that initial market optimism. All right. So, if this political instability does prevent her from smoothly executing that plan, what happens next? What specific compromises might she be forced into? Could she be pushed towards policies that aren't big stimulus, maybe delays, or smaller packages, or focusing on something else entirely? What kind of legislative compromises would signal to the market that the expected path for growth and inflation is now broken? And crucially, how quickly would global bond markets react to that kind of divergence? Could that be the trigger for the yield curve flattening or inverting we talked about? It's definitely something to watch.
A really compelling question to keep in mind as this situation continues to develop. Thanks for joining us for this deep dive into Japan's critical political and financial crossroads. We'll see you next time.